Hello investor Janta, welcome back. In this video, we will talk about price to earning ratio, which is also called PE ratio. We have already talked about the basics of PE ratio and about factors which determine the PE ratio in our previous videos. Link of those videos is in the description. Here, more specifically, we will talk about the relationship between PE ratio, price change and earning growth. Before proceeding further, let us brush up basic mathematics from our school time. If a number, say C, is equal to product of two numbers, say A and B, then any percentage change in A and B will lead to change in C. That percentage change in C will be equal to percentage change in A plus percentage change in B plus product of percentage change in A and percentage change in B. For further clearing the concept, let's take an example. Let's say A is equal to 10, B is equal to 20 and consequently C will be equal to 200. Now let's assume A is changed by 10%, that is A is equal to 11, which is 10 plus 10% of 10, and B is changed by 20%, that is B is changed by 4. So B will be equal to 24, and product of percentage change in A and percentage change in B is equal to 2%, which is 10% multiplied by 20%. With this change of A and B, new value of C will be equal to 264, which is equal to product of A and B. The change in C is 32%, which can be calculated as 264 minus 200 divided by 200. You can see that this change is exactly equal to sum of percentage change in A, which was 10%, percentage change in B, which was 20%, and product of change, which was 2%, that is 10% into 20%. Most of the time, product of change is very less compared to change in A and B, as in this case it is only 2%. So it can be ignored sometime. We can say as a thumb rule, if C is equal to A into B, then percentage change in C will be equal to percentage change in A plus percentage change in B plus percentage change in A multiplied by percentage change in B. Now coming back to topic of the day, we all know mathematically price to earnings ratio is nothing but price of share divided by earning per share. With that, we can say that price of share equal to PE multiplied by earnings. From our earlier discussion, we can say that percentage change in price is sum of percentage change in PE, percentage change in earnings, and product of percentage change in PE and percentage change in earnings. Let's take an example. On 15th May 2020, PE of Laurus Lab was 17.5 and earning per share, that is EPS, at that time was 5. Price was around 87.5. Fast forward to 20th May 2022. PE is improved to 41.1 and EPS improved to 13.97. So there is 135% increase in PE and 179% increase in earnings. Both these changes has resulted in increase of share price to 574.5, which is growth of 557%, around 6.5 times. If you carefully see, this 557% is equal to 135%, which is change in PE, plus 179%, which is change in earning, plus multiplication of 135% and 179%. From this discussion, we can say that we will get the price appreciation through two routes. One is by improvement in PE, which is also called PE re-rating towards upside. Another is by increase in earnings. We can also say that price appreciation will happen only when there is either PE re-rating towards upside or earning growth or both. One should note that we are talking about future earning growth, not the past one. Now question comes, how this knowledge should affect our investing decision. It is quite clear one has price appreciation when either there is increase in PE or increase in earnings or both. To find out future earning growth potential, one needs to do the company analysis and industry analysis, which we have briefly discussed in our earlier video. Link of that video is in description. Good analysis will tell us whether there is any future earning growth potential or not. Let's understand this with an example. Let's take the case of company HUL, Hindustan Unilever. This company sells FMCG products like oral care products, skin care products, etc. Since last 5 years, its earning growth fluctuates between 10 to 20%. It is an ordinary profit growth, but very small compared to other growth companies like Lotus Lab, which has shown an earning growth of more than 100% in some of the last few years. To know whether there can be any earning growth trigger, one has to study the company in detail. Growth can come from penetration in new market or penetrating existing market with new products or both. It can be due to efficient raw material procurement, which results in decrease in cost. There are many possible earning growth triggers. We will talk about those triggers in some other video. From this discussion, it must be clear that finding growth trigger may be little difficult, as it requires in-depth analysis of both of the industry and company. That's why it is said to invest in your circle of competence, that is, another sector about which you can identify the growth triggers. For example, it is easier for an IT professional to identify the growth triggers in IT industry rather than in steel industry. This was about the earning. Now what about PE? We have discussed PE in much detail in one of our earlier video, where we have discussed factor affecting the PE. You can find the link of that video in description. But here it is important to mention that sometimes you can get good companies at much lower PE, especially when there is a panic in the market, like what happened during a COVID outbreak, war or high inflation, etc. When things get stabilized, PE improve and one gets the benefit of PE re-rating. But it is not easy to buy during this crisis time. You will able to buy good company only when one, you have money to invest, and another, you have to have courage to buy that company and patience to ride the volatility. As famous American investor and mutual fund manager Peter Lynch once said, stomach is more important than brain in stock market. Having understood about the concept of earning growth and PE re-rating, one has to spend time to do the company analysis to find the good investment opportunity. But what about those investors who don't have time to analyze the company? Does that mean a person who is busy in doing his regular job or business cannot invest by himself? For them, there is a solution, which is to invest in index fund. We will discuss about the index fund in detail in our next video. Here, to summarize, price appreciation comes from two routes, PE re-rating and earning growth. To know that in a company whether there is a future earning growth potential exists or not, one has to analyze the company and industry. One should try to find out good company at lower PE to get the price appreciation from both routes of PE re-rating and earning growth. Pessimistic events at any of the level, be it global, country, industry and business level, makes good company available at lower rate. Hope this video helped. Thanks for watching. If you have learned something new, please share and like the video. Subscribe for more.